Yeah, I mean, the exact sales I'll try to reverse engineer it, but in total I made $100,000 between sophomore year of high school and then freshman year of college. And let's yeah. And what's funny with me, so I already had a car. I had my clothes, so I didn't spend any money. The only thing I did is I got a speeding ticket, and then in response to that, I bought a radar detector. Otherwise, I literally spent zero. I'm Drew Breneman, and this is the Rise and Invest podcast. I bought my first two properties as a 19-year-old with my own money that I earned from an online business I started in high school. I've now grown my portfolio from that first duplex to hundreds of millions of dollars of investment property. My goal with this show is to give you the resource I wanted when I first started out. Subscribe to our podcast where I break down real-life stories, tactics, strategies, and current market information you need to be a successful investor. Welcome to the Rise and Invest show. I'm Drew Breneman, a multifamily real estate investor. I bought my first deal when I was 19 years old with my own money. On the show today is Joe Smazal, multifamily broker here in Chicago.
What up?
Hey, so we're going to get into some deal stories today. Kind of hopefully things where if you're looking to buy or sell property on your own, you can gain a lot of insight from hearing about some of the deals we've been a part of. All right, well, nice. Well, yeah, I had Joe had you on in a previous episode. Had a blast.
I'm glad I didn't mess it up too bad. I got invited.
I know, yeah, that's right.
Well,
so,
I might have messed. I don't know. I'm back.
Yeah, so you're back, and I think we kind of got into some of the ins and outs of brokerage and maybe what a buyer can do to set themselves apart. Didn't really ask any sort of war stories, deal stories, except for the first deal. So, I want to, get into some deal stories from you. And then, too, if you got any questions for me, things about my story or about as a buyer.
Why don't you start with the first? Because you just, in the intro, you said that you bought your first deal when you're 19 years old with your own money.
Yeah. And then
start there. I mean,
okay.
you share that because I don't know the story.
Okay.
So start there.
Yeah. So cool. Yeah. So both my parents are teachers. So it wasn't like I'm from like a real estate family or anything, but real great place to grow up though. Cause then all summer, all the time we had tons of time together. Cool. So playing any like sports or anything, we went to the batting cages every day and, was a good time, but there weren't any like business connections or any money to work with to start. But I was always real entrepreneurial as a kid. And actually I started my first business doing magic shows. Did I ever tell you about that or?
No.
Yeah. The first business I did children's parties for magic shows. So it was a hobby to start with.
And you're how old?
Starting in 6th grade, I started doing magic, but just as like a hobby. And then by I think 7th and 8th grade, I did kids parties. So for $50, I would do 20 minutes of magic and then 10 minutes of balloon animals. So in the balloon animals, like the guy at the magic store, his whole thing was that's going to be, you get something to take with them. Everybody loves it. And every show that I did, I ended up getting paid $60. I didn't know about tipping really, but I remember leaving everyone like, oh, I must have really killed it. They gave me 320s here.
You still got it with the balloon animals?
Yeah. No, I still can make the dog and some of the main giveaways. Yeah. And especially the card tricks, I still can do those. So that was my first business. And then I started, I saw some of my friends playing this video game, Diablo 2 online. I had never played it before, and it wasn't really the kind of game that I so much liked from a video game standpoint. It was these games where you just go around this world like attacking things, basically just clicking. So I liked sports and strategy type things more. But they told me, they're like, you can sell your items when you're done for real money, like on eBay. And I was like, oh really? Let me. That sounds more like something I'd want to do. Let me look into this. And they, so I go on eBay and. So the same thing. Sometimes it sells for $5. Sometimes it sells for 15. So, I didn't know what an inefficient market was, but at the time, that's exactly what it was. You could bid on an auction. And it's funny this was probably in my freshman or sophomore year of high school. I'm doing this. And so you go, like, well, yeah, you can just win this auction in the middle of the day on a Saturday for $5 and then list it for 15. Now as an adult, I get the like both sides of the buyer. Like, okay, if you're a busy professional, pay $15 for the item, whatever.
Cost what it costs when you want it, right?
At the time, I had no idea. I was like, I don't understand why these people are paying $15 when you could just buy it for $5 and blow your whole Saturday on it. Started just I bought one thing, I resold it. It was an armor set. Like I bought it for like $5 and sold it for like 10, and just kept doing that. And I ended up doing between probably 5 and 10,000 transactions over the course of 4 years. So my like eBay feedback still, if I wanted to sell something, I have like 5,000 positive feedback on there. Yeah. And
what'd you make from was your average one like $5, $10?
Yeah, I mean the exact sales I'll try to reverse engineer it, but in total I made $100,000 between sophomore year of high school and then freshman year of college. And And what's funny with me, so I already had a car, I had my clothes, so I didn't spend any money. The only thing I did is I got a speeding ticket, and then in response to that, I bought a radar detector. Otherwise, I literally spent zero. And so what I started doing was with that money, but just to answer the transactions question, is like between 5 and 10,000. So yeah, probably making about 10 to $12 a deal, and then every day I'd come home from school and there'd be 20, 30 deliveries to make, and I'd.
So let's get in. So did you like the rush of the transaction? Or did you like seeing the money in your bank account accumulate? Or what was the... It was you're a kid, so there's a game in it for you there, right? Like there's something in there. What part of it was like gamified for you?
That's interesting. I mean, well, I like to wheel and deal. Like I like that, like just the buying and selling part. And and I liked that, I guess the success I was having with it, where I would really be pumped to come home. And because also one thing, this is before smartphones, before you could go to the library and go on the computer during like study hall or something. So you'd come home and then you'd see what happened actually, and you'd have a inbox full of orders. It's a rush.
Probably a healthy thing to like think about sometimes these days when you're like, sometimes if you've got the machine created the right way and your business is operating, your team is working the way that they should and everything, stepping away from it sometimes and seeing what it did when you were away is really gratifying, right? Because it's the machine that you built, and then seeing it produce when you're not there is a cool thing.
Yeah.
So, all right. So I didn't know any of that. So you're a magician turned like video game broker, token broker who's got now 6 figures in his bank account. That's so where does it go from there? Where do we get to real estate?
So as I'm making the money, I'm looking into what I can invest it in. So one thing my parents, especially my dad, he was real big on investing.
That's like a high school kid, by the way.
Yeah. Right. So as a high schooler, what I did in the summer was I went to the library and I would get books like Rich Dad, Poor Dad, Think and Grow Rich, all the books people when they're like 40 are like, you should read this and do this. I read it when I was, 16. And where we got to real estate was, so I read all these investing books, and most of them started out with the stock market, Intelligent Investor, and just different books that everybody hears about. And so I started trading stocks and options. And so, but again, with no smartphone and being, 16, 17 years old, you don't have a lot of patience. So I put on these like call spreads or other trades, or just buy something like buy a stock. And then if nothing happens in like 2 days, you just like sell it, and also too, with not seeing the stuff during the day and just kind of, the market wouldn't even be open before I went to school. So you try to put on a trade, hope it would open and you could put it and it would go through, and then you come back and the market's closed. So it was a really not a good strategy. So I lost some money doing that, not a crazy amount, but so then
enough to learn a lesson.
But it was not a tiny amount. Like definitely I lost more than 10 grand with the stock trading idea. And so as I'm doing that, I'm looking at other investments and reading about it. And I read a book about real estate investing, but it's just by Gary Eldred. It's called Real Estate Investing, I think. And for a lot of the new employees or new people, especially an intern, like I buy the book for them and say like, you should read this. And it's not geared to like running a fund or getting investors or anything like what we're doing today. It's more just, you want to buy a duplex or something, here's how it would work. And then they talk about property management and get the whole thing.
Have you reread it?
I haven't, but there's a lot of things that still have taken away from it.
You should reread it. I bet it rejuvenate you. It'd be cool to kind of go back to the blocking and tackling.
Yeah.
But it's fun that you gift it to your employees, though.
Yeah, and and also too, it's a good way to tell how interested they are in real estate. If you give them the book and then they never read it.
I remember there was a book that they gave to brokers when they started to, and I read it. It was like 10 Habits of Highly Successful Brokers. Like Brokers Who Dominate or something like that. And I gave it the same thing. I gave it to everybody who I was mentoring. I think everybody said they read it. I don't know if they did, but
that's funny. So reading that book, I mean, really what stuck out with me is like real estate's a combination of an investment in a business, and then it's kind of like a bond. And so I really, they got into the 4 ways you make money in real estate. So cash flow. So you collect rents, you pay expenses, there's money left at the end of the month. Then that's one way. Then the building obviously goes up in value and it appreciates. And then you pay your loan down over time. And then you get this tax break called depreciation. So those are the 4 ways you make money. I didn't, the depreciation thing, I didn't really grasp how that would work. Yeah. And then they just had such a simple example. And then comparing it to my stock market investment, what really resonated with me was like there'll be some cash flow. And then their example in the book was you put 10% down. And then the building, I'm reading this in 2003.
Okay.
So I'm reading this book in 2003. And, from since beginning of time almost to 2007, homes have just gone straight up. So I'm reading this in 2003 and they go, homes go up 3% every year, just like clockwork. Here's a chart since the 70s. It's the like clockwork thing got broken later on. So if you put 10% down, it goes up 3% a year. That's a 30% return, not including cash flow, not including paying the loan down, not even factoring in the tax breaks. So I saw that. I'm like, this sounds great. Like, let's do it. And so I'm from the Milwaukee area. I'm from Delafield, Wisconsin. And
so is there a sounding? Is your dad the sounding board? I think you mentioned your dad doing some studying, or your mom. Like, were your parents your sounding board for this? I mean, you're young, and I know at that point, like, you're wise beyond your years, or you're like thinking. You're thinking about different things than a 16-year-old or 17-year-old is used to thinking about. But who's the gut check for you in this?
Well, what's interesting, so they would definitely listen to what I was saying, where they were not just like, oh, okay, nice idea, and like not there. They were definitely listening to what I was saying, but they don't have any like business experience, and then they don't. The only experience they had as a landlord themselves, they purchased a farm like in the 70s, and it had a house on it that they're thinking of moving to, and kind of like middle, in the middle of Wisconsin. And you don't get very good tenants at whatever it was, $100 a month in rent in the kind of in the middle of nowhere. So to them, they just thought this is going to be like could be a lot of trouble from their experience, at least as being the landlord. And then but they're not they're not telling me not to do it, they're not telling me to do it, they're just kind of listening. But they saw me succeeding with the other stuff, with the magic shows working out and then the internet thing taking off. So no, they were supportive of it, but they weren't.
They didn't talk you out of it. They didn't talk you into it. They were like a healthy level of being constructive. They were for sure supportive, and they were, but not supportive to the extent where like, okay, great, you made you got $80,000 left from that money you made. Cool, we'll put another 80 in. Like that never happened. They never. But totally supportive. We didn't need to do it, but then because I had like documentable income from the business to get the loan approved, I could get a little lower rate if they co-signed, and they did. Okay. So I mean, they did do plenty to help. So what'd you buy? I want to hear. How'd you find the deal, and tell us a little bit about the first deal.
Yeah, and then I guess I'll back up a touch just to on kind of how it all played out. So I'm from the Milwaukee area, and then I already had gotten into UW-Madison, University of Wisconsin-Madison. But I went there because it's like an hour away and it's in-state tuition.
Yep.
So I wasn't thinking about real estate yet or anything. I got in. I was actually, if you had asked me like when I was a senior in high school what I'd do, I wanted to be a doctor, some sort of, they'll call like easier like medicine, like a dermatologist, not like where you're a surgeon. That seems really stressful and difficult. And at the time, like Subway restaurants were really popular. They were just blowing up everywhere. And someone I knew worked at Subway, just as like a high school friend. And that guy owned 3 Subways, and he had a Porsche and was making hundreds of thousands a year. Not the high school kid, the person who owned the 3 Subways.
Okay.
So this is like, okay, let's see what that guy's doing. Maybe I should be a doctor, like Monday to Thursday, Mr. Dermatologist, and then start opening all these Subways. That's what I was thinking I would do in high school.
Yeah.
But then so I get into medicine, and I'm thinking about doing medicine, and I was already, fast forward to like orientation, let's say. I've been reading a lot more about real estate up to that point, and just on the class sign-up day, I decided, I'm going to major in business. I actually hadn't decided what I'd go into. I just thought, like, I'm liking this idea of opening up a Subway or investing in real estate or something more than medicine.
Okay.
And so then, like, maybe majoring in accounting or finance would be better.
Okay.
And then where I lucked out in a big way is that UW-Madison, they have, depending on the year, the number 1 or number 2 best undergrad real estate program. So then I ended up, majoring in real estate and getting a degree in it.
And you just went because the tuition was cheaper and it was close enough to home.
Yeah.
Far enough away from home, I guess, too.
Yeah.
Right? But
so it worked out.
Lucked into a world-class real estate program.
Yeah.
Okay,
and
cool.
a lot of my, like, good friends today, it's like most of them, they went to Madison, they're in real estate. Like, it's a tight crew.
I'm a Hawkeye, so you're not going to get a whole lot of like support from me on this, but it's fine.
Yeah.
I'm with you.
And so, but in terms of the first deal, so then I get a realtor. So I go to UW-Madison. I'm living in the dorms, and I decide, okay, I'm going to buy a property while I'm a freshman, so that I'm going to have a place to live sophomore year.
Okay.
And so I get a realtor. We start looking at deals, and one thing too, starting out, and so as like a general tip I'd give everybody listening or watching, and give to everybody, like, starting out, there's so much you don't know, and you could just get so overwhelmed on. So also too, people who would start out and they're raising passive capital and getting a big loan or it's a rehab deal, that is, now that's easy for me, but the first time this would have been crazy.
Yeah, you started at 101. I mean, you started your real estate investment with the duplex. I mean, that's the basics, and you learned it from, well, go ahead and tell us.
Yeah. And so I basically just learned by doing. So I started out, and really what I was focused on that first deal was just make sure it's cash flow positive. I don't really, the way they're valuing these properties, I think I get it. And then the tax breaks and paying the loan down, like I get most of that, but not, like, to me, like, just set up a deal where the worst case scenario is you overpaid, but you're still making $200-300 a month in cash flow, and then you just hold it. So I spend most of my time really making sure on that first deal. I mean, obviously, then a duplex, people in Madison, they were using a gross rent multiplier to value it. So I could value it.
So what was it? What was the GRM?
10. Yeah. So the market was a 10. If something sold for an 11, that was just someone grossly overpaying. So it was, around a 10.
Yeah.
And so I found a deal that, would have been a 10 GRM if the whole thing was leased. But one of the units was empty. One was rented, which wasn't a problem for me because I was looking to move into the place potentially the next year. So I ran the numbers. When I say numbers, I'm not talking about like what's your net IRR to your LP. I'm talking does this make money
rent,
monthly?
Expenses, insurance, gas. Yeah.
Yeah. And so, right. Yeah. And of course, so I run my numbers, probably no management fee in the budget or leasing fee or anything.
No vacancy, no reserves. Yeah.
Yeah. So then but for sure, I probably had vacancy in there, but definitely not the other stuff. And then, but the basics, real estate taxes, insurance, maintenance, that sort of stuff. And it was, depending on what I could hit for the rents, it was going to be $250 a month positive cash flow with me living in one of the bedrooms. So then if I wasn't in there, maybe rent's not that high in Madison at the time, maybe $700. So anyway, so I don't waste time. I buy it, get it under contract, get it closed with a bank loan, put 15% down.
How much was it?
The purchase is $220,000.
Okay.
So then, 15%, it was about $50,000. I think that might include a little bit for closing costs.
Yeah.
But it was about $50,000. I ended up buying it really right from a price standpoint. And then, a year later I sold it for $270, $280. So I doubled my money actually on the first deal, 2X in a year.
Just like the days of selling like video game tokens.
Yeah.
Man.
So then,
you got a little taste of it, huh?
And then once I bought, and also too, it's funny you bring up the video game thing. So I said I started out with doing Diablo in the 2, and then all these other games popped up along the way, and I got just smarter how I did it. I didn't even buy the games. I just knew people who had the items, and then I would have them delivered to the customer. So anyways, point being, I did Lineage 2 and all these other games, and then I was doing this, selling gold or something in the Star Wars game. And when I'm a freshman in college, when I bought the rental property, I'm like, well, let's focus on this. And then that's when the video game thing stopped.
Doubled your money in your first deal. It's a pretty good one. I don't know if we're sharing it. We're sitting in Rise and Invest office, or the Rise Invest office. Like, we're going to talk about, there's a lot of space between $220,000 duplex and this luxury boutique building in the middle of Fulton Market, West Loop, that you bought for mid-30s, low 30s,
32,
yeah,
0.8 million. But yeah, let's
COVID.
Yeah, I'll keep going on the story where and then just kind of hit it chronologically, I think. Okay. So I bought that first deal when I was 19, and then a few that fall. So then I think I'm still 19, but then it would have been the start of sophomore year. I bought another duplex on the same street. Then the following year, I bought another one, 3-unit.
Did you keep those, or were you flipping? Or
I only ended up flipping.
Way to put it,
yeah, so the first one I had for a year. The second one I had for maybe 5 to 7 years.
Okay.
The third one I only owned for a year and change, and then the fourth one that I bought when I was a junior, I owned that for 10 years.
Okay.
So numbers wise, that's how the first deal went, where I owned it for a year and doubled my money. The third deal was another. These all ended up being value add deals. I just never heard that term, and I knew what the rents were so well from being a student there, and you could talk to your friends.
Yeah.
That then, I was buying deals where the rents were below market, the GRM was low. It was just perfect storm, good buys. And one of them, the third deal I bought, I paid $650,000 for, and I had a broker tell me I'd be able to sell this for $925,000 a year later. Then, unfortunately, that was 2007. He told me that, and by the time I started selling in 2008, the market had dropped some, so I didn't sell it for $925, but I sold it for I think close to $800,000.
Okay,
so still a
good
big
deal.
win. Yeah, and then that third and fourth deal, I basically put no money down on those, because as the lending environment got even crazier, you could just now I'm a experienced real estate investor with my 2 deals and get no money down loans. So that so that in terms of a multiple return, I mean, I didn't really put any money in.
Infinity multiple.
Yeah. So then I one thing that I sort of learned though, selling those deals, don't take the money out of play. So what I did was I sold that third deal, and maybe let's say I put nothing down, maybe I netted $100,000 from that. But I didn't put that in another deal. I just had it. And then that just kind of get, spent, invested wherever it went. Whereas if I would have ideally you would have put that in another deal right away, whether it's a 1031 or not, just get it into another deal and let it keep compounding. Or I really wish I wouldn't have sold it, because I had another deal that was actually, my fourth deal wasn't as good as that one that I had sold, which it would keep the numbers in order. That was the first and third deal I sold pretty quickly. Then the fourth one I kept.
Fourth one you kept for 10 years. Second one you kept for 7. You said 5.
Yeah, that one I don't remember the timing as much, because it's not a round number. The other one I owned it for exactly 10 years.
Okay.
And what happened on that fourth deal, which wasn't as good as the third, I paid $670,000 for that one, and I sold it for $1.2 million. So that one, I could have done the same thing on the other one if I would have just left the chips in play.
And you're in college still?
Well, I bought all 4 when I was in college.
Right. Okay.
And then I sold the first one while I was in college. The third one I sold, I had just graduated, so I was 1 year out. And then the other ones, I was.
So you I don't know if you want to talk more about your time at Madison, but fast forward, you graduate, you've got a few buildings in the portfolio still.
Yeah.
You're evaluating which ones to sell or to keep. This is in 2000 what? You graduated in 2008?
2007.
2007. Yep. Okay, so where do you go from there?
Yeah, I'd invested all my individual capital. I never crossed my mind to get investors or anything. I didn't know anybody. There are no family members or friends that could have. So I don't think that even crossed my mind to try to get investors. It was just investing my own money, doing deals, and I had sort of put all my money out there on the table, and then It was 2007, the winter. I graduated December 2007. So I could see things also slow. It was already slowing down in terms of
like you were getting feedback on your deals from the agent that it wasn't at the clip that it was at.
Or just the sales market, you could tell just looking at the deals. I don't remember if any were for sale at that point, but just you could just tell like things were going to hit a slowdown.
So hang on there, because a lot of people can't tell, right? I mean, a lot of people couldn't tell in hindsight. So what do you identified it in the inventory first, or the pricing metrics, or
no? I think with it 2007,
the spidey sense, or what?
No, it was. I think by we were on some sort of real estate field trip, which I think was in September 2007. We went to Chicago, and some lending, like some debt brokers were talking, and there already was like a failed like CMBS auction. There was actually, it wasn't no spidey sense. It was actually already starting. If I and so no, it was more just kind of, you could tell some sort of thing was going to happen. So let's go work at a big place and let's learn from the big boys, so to speak. And so it's interesting. I mean, recruiting in December when the economy's slowing down, like you sort of made my own way. Like I had a friend who interned at Dominium, which is where I ended up working an apartment company. They're all over the country, like a top 50 owner in terms of units. I think they're at like 30,000 of billions of property.
Jeez.
Yeah, more or less it's owned by like 4 or 5 people with no outside money. So their system, they do affordable housing. So they, like their investor, so to speak, is they, create affordable housing. They get tax credits. They sell them to investors. They have the cash to then fund the deal with debt and equity. And so was a great place to learn. I mean, really a fun place. I was only there for a year because I got a different offer, or a friend of mine worked at a retail developer in Rockford, Illinois. And, it's interesting. Like the pay jump was huge. It was almost like double. So, you couldn't pass that up. But what's funny is from an education standpoint, I probably would have been better off just staying at Dominium with all I would have learned. So I do tell that to people now, where if someone's asking like, what should I do? Like my career advice to people, it's get to your spot. Like if you want to do real estate as a principal or something, then you just need to get to the spot. Like don't take a job as a lender because it pays a little more, or it's there. Like just, even if you need to be the, whatever, intern or running errands for them, like you're in the door. Download our 100+ page passive investing guidebook today. Accredited investors can sign up for our multifamily investment opportunities as well by hitting the Invest Now button on our website. Now back to the show.
It's hard to know that you're there, right? I mean, I think the challenge is looking forward to where you want to be in 5 or 10 years and not wasting time doing something because it's a good job in the meantime, right?
Yeah.
I mean, having the courage to go for it and get to your spot, sooner is better, because the more time that you waste doing something else, you might be making a better living in the present. But if you're not happy and it's not what you want to do long term,
right, exactly,
it's a waste in hindsight, right?
Yeah.
But it's hard for 22-year-old Drew to identify that. So
yeah, and I wouldn't have known that at the time, and then that pay difference was so much that would have been hard to, even if I'd known that, to pass it up. But especially now, since I'm doing only multifamily, like obviously working at a multifamily place longer would have been super helpful. But at the same time, I learned a ton about commercial property, because that's what they did at Rubloff. All they did, the place in Rockford, all they did was commercial deals. So then
retail centers, you said?
Yeah, they own some office too, but it was all shopping centers, and so learned a ton there. And I bought that product type on my own too, and so that was mostly all learned at Rubloff. So it was helpful.
And now you're in Rockford.
Yep. Okay. Yeah. So fast forward to and actually I'll jump back to talk about the start of Blackhawk. So I started a company with 2 other guys in 2008.
Okay.
We were just sort of at the start of it, moonlighting, so working after work, basically nights and weekends on this business. So when, I told my story kind of like this to one of the interns there, Brian, and he was like, that's great. You're doing deals on your own. We should go talk to my dad. I think he'd want to, like, he's bought, the building that his business is in. He bought that. Might be interested in investing in property. So, I don't waste any time. I was like, great, let's go talk to him like tomorrow if we can. And I was printed off deals off of LoopNet. I didn't underwrite anything. I just had them printed out, and, just
Retail deals?
All sorts of stuff. Just
Okay.
and also I don't know how much he wants to invest. So I've got a $200,000 duplex. We're all in Minnesota. That's where Dominion is based, and where we all were living. And so I got a $200,000 duplex in the Dinkytown neighborhood. I got a $3 million shopping center in the Uptown neighborhood in Minneapolis, and I got a $5 million condo deconversion or something or another in the Bay, San Francisco. I just like a whole, what are we interested in here?
You got it with like an Amazon distribution.
Yeah. And they weren't like fully underwritten or anything. These are just printed off a LoopNet. Like, what are you thinking you like? And so we go meet with the dad and, just kind of tell them what I'm up to, and they liked it. And the dad, he really liked this $3 million shopping center. And I remember going like, all right, guys, like, I think I said this out loud, or I for sure was thinking it if I didn't say it. I was like, it's like probably $1 million like down payment for that. And then they're like, yeah, of course we know that. And so it was like, to me, it was hard to wrap my head around someone investing that kind of money in a deal. I hope Jim's fine with me saying all this, but like that first deal, he invested $520,000 in, and I still, the whole thing was totally surreal. Cause again, with my parents, I mean, they never would have that kind of money to throw in a deal. And I didn't know anybody even in my whole life that I had met, I don't think could do that.
So what was it that Jim saw in you and Brian at that time and starting it out? Was it an enthusiasm for the business? Was it your track record? Did you just happen to find the one of 1,000 piece of real estate that was the right deal that he was looking for? Or,
no,
it's a big commitment,
Yeah, and I think because if you think about the track record at the time, I mean, sure, I had done some deals, but to then buy a multi-million-dollar property when I've only bought stuff that was 700,000 or less, a tiny amount might have been track record, but and also too it's kind of funny in retrospect. Like, I was a year older than Brian, and I was in the workforce like as a full-time employee. He's the intern, so I'm like coming in more as an expert. I'm like full-time, and then as this real estate professional with 2 months of experience, in the workforce.
Yeah, by comparison, you're the vet, right?
Yeah. So then it was a lot of, I'm sure, enthusiasm, wanting to support us, I'm sure was a big part of it. Like, if this is something that you and Brian really want to do, he's not going to just throw money in something that doesn't make money. But a big thing for him, I'm sure, was getting us going. Yeah. Like, I know that. And then in 2009, which is when we were looking at this in 2008, you could buy that shopping center. The tenant was Verizon Wireless and half of it, so just the best credit you could imagine. And then, we bought it like a 9 cap and we borrowed at 5. So the cash on cash was almost 20%. So jeez. Like what, and then so we could deliver.
Was it bank financed? Or?
Yeah.
Okay.
We could deliver a huge return to him. So you could go like, regardless of what the splits are between the three of us, like the deal level, cash on cash, it probably was like 18% on that deal. Plus you're paying down your loan a ton because it's a 25-year amortizing commercial loan.
Yeah. So
if you like don't even factor in any appreciation, you're pushing like in the high 20% per year return. So is a combination of all that. I would definitely not say it was like the track record though.
Yeah.
So it was him, wanting to help us and, seeing a good enough deal to do it. Just to jump back to being in school for a second, at UW-Madison is really tough. They have 2 classes that they have really difficult curves to get into the business school. So you get into UW-Madison, but you need to apply when you're a sophomore to get into the business school.
Okay.
And I don't know what the yield is, whatever it's called, who gets in, but everyone got tripped up on psychology and accounting, not because they're necessarily the subjects are hard. They just had really tough curves.
Okay.
So I found out about this, like we'll call it a loophole, where if you take the class in at a different University of Wisconsin university, so like University of Milwaukee or Waukesha or Eau Claire, or just, the credits transfer, but the grade doesn't. So I heard that and I go, great. I won't need to worry about this curve where everybody gets a C, or whatever it is. And then, so my sophomore year, I take those classes at UW Waukesha. I live in my parents' house for the summer. And I totally just get around this whole like difficult thing and just basically walk into the business school, basically a 4.0, because I got around the 2 tough classes. And what made me think of this thing too, it was another sort of like hustle story, which maybe, Jim or Brian would have liked. So then I'm doing those classes, but that doesn't take up all your time. And I had I was looking for deals, but I wasn't really like prospecting owners or anything. It was just sort of inbound or what hits the MLS and then just move on it. So I decided, why don't I start a vending machine route? So I'm living at my parents' house and Madison's like an hour away. So what I do on the days I'm not spending time on school, I literally have the yellow pages open and I'm cold calling businesses to place vending machines. Like, this is what I do for my summer. Like, I have a open summer. The class is like 2 days a week. What do you do? Did I go to the beach or whatever? No, I'm like, we need to start a vending machine route. So I call, and then was a nice setup where you partner up with the charity, because that helps you get in the door, and then also you're donating a portion of the sales to the charity.
Oh, cool.
So then you have like a reason to call. I'm with this charity and we're looking to place vending machines, and like the best place, my best location was the Burlington Coat Factory employee break room. Those folks that are sitting in there having their break.
What
looking
sold
at this.
the best?
I don't remember,
is that like a Funyun market there? Or is it more
yeah, no. I was selling just pure. It was just only candy, because what I did. So I saw these, and I think how I got the idea was I saw these machines on eBay, used for like $100. There's the ones you just put a quarter in and turn it, and like a handful of candy comes through. Not the ones where we're selling, like chips and stuff. It's a pretty simple business. You place the machine, so they say, yeah, it's cool, come set it up, and then you go to Sam's Club or wherever you want to go and buy candy in bulk. So I would do Skittles, regular M&Ms, and then I'm forgetting the name of the other one, but there's like thinner sugar candies that Mike and Ike's. So yeah, those were the 3 I'd go with, fill it up, and then and I ended up placing almost 20 machines that summer.
Really?
Yeah.
There you go.
And then what's funny, probably my junior year, I'm like, what am I gonna do with this route when I'm probably not gonna live in Madison after I graduate? What do I do with the route?
Just pay some kid to go around and pick up the quarters?
The only thing I ended up, believe it or not, I sold it.
As a business?
Yeah. So I put it an ad up on Craigslist. Or
did you hire like an investment banker? You called Lazard and you said, hey, I got a vending machine route?
Yeah. They, I just posted it on Craigslist, and someone who basically that's what they do was like, well, this is great. These are already placed, and I already got, hundreds of machines, basically what the guy did for a living. And he bought it from me, and it's funny. I got like a premium because they were placed. I'm trying to think. It wasn't like a crazy premium, but like maybe I probably had $1,500 into buying the machines, and then I sold the whole route for $2,000 something. So not where the money was made. It's just in the monthly cash flow.
Yeah.
Like, it was funny, like a pretty cash heavy business where there was.
So Jim saw that you were hustling. He saw that you were into real estate. He saw that in your downtime, like, you found other ways to make money. I mean, I think that probably translated into. So you guys buy a $3 million shopping center with Verizon as an anchor tenant. It's wildly successful from a cash flow standpoint out of the gate. I imagine you guys identified that pretty early. It's like, all right, this is going well. So do you go back and talk to Jim and Brian, like, hey, there's something really here? I mean, we're successful on this deal.
And actually from the first deal, we already had set up the company, the Blackhawk Investment Group.
Okay, so you thought about it as a bit. That was the first deal of a business. It wasn't one investment in a silo.
Exactly.
Like you were on that was the track to Blackhawk Investment Group.
Yeah. Okay. And so the 3 of us, we're going to be partners. We're going to Jim's going to be the investor, at least to start, and then this is like our first deal. And so that deal is the first shopping center we bought was one of the most memorable deals that I've done, just because getting that first one done and seeing like that amount of money coming in from an individual investor, and just is a totally different deal buying a commercial deal versus the biggest deal I bought to that point was a 3-unit for $670,000. So
were you doing like the interviewing the tenants and stuff, and you were
at that point I never had actually heard of doing that. Those tenants really wouldn't have been a need to interview them, because it was actually a 1-year-old building. So I mean, I'm sure they were good with what they had there. But that deal was just, again, I would try to keep it simple. Let's focus on the cash flow. I mean, it's 2009. Who knows when things are going to turn? But I mean, with whatever, let's just round it to 20% cash on cash here. We'll have all our money back in 5 years. These leases go more than 5 years even. And not that it's going to be worth zero and that we are happy we have our money back, but I just try to keep it simple. And then, go ahead.
So how long did it take for you guys to get your arms around that before you were out looking for the next one?
Immediately. Yeah, we had like our meeting in the fall 2008. We identified that property. We started buying it right away. Okay. Then we closed on that one January 20th, 2009. It's the same day Obama was inaugurated. Easy to remember. Okay. And no, we had it that already we're looking at additional things to buy while we were closing that one. And then pretty much for 5 deals in a row, we just always had another one immediately right away. Okay. Like we were a week or two away either before closing or after, and we had another deal going.
All shopping centers?
One was all commercial, at least. Okay. One was an office building, one was industrial. The other 4 were retail deals. Yeah, shopping centers.
And you guys are, so you're in Rockford, Brian's in Rockford, Jim is in Minneapolis. Is that's still the attachment to Minneapolis?
So the first year, so we met up in the, let's call it the fall. I think he was a fall intern or summer. I guess I don't remember because they did have summer and spring interns too. But what ended up happening is, and how we got off on this was I want to go back to the Blackhawk thing. Blackhawk we set up when all 3 of us were living in Minnesota, but then pretty quickly thereafter, I got the job in Rockford, so I moved there. And then Brian went back to school. He still had to finish his senior year at he also went to UW-Madison and majored in real estate. So during at least probably the next the first 2 deals, that's where we all were. Okay. And then by the third one, which would have been like August 2009, Brian was back in Minnesota. Okay. I was in Rockford from 2008 to 2011.
So Blackhawk as a business, as a brand, what you were thinking that it was going to be an owner of commercial only real estate, or how did you see it when you at the inception of Blackhawk, and then as you acquired more and more, how did it evolve, and then how did you see it after you had a really established portfolio, because it turned into a big business? I mean, it started with a $3 million asset, which is not insignificant, but it kind of ended. Yeah,
and in total, we bought, I think, just a touch over $100 million of property, the 3 of us. Yeah. And so, it kind of, initially, our strategy was just finding deals that were fully occupied or very close to it and that were buying at huge discounts. And so and we were only looking in the Twin Cities, so Minneapolis, St. Paul. So there really weren't that many, at least deals that we were seeing, like discounted apartment deals. It's like most people were let's just hold it. Yeah. Okay, you're telling me my value's down 20, 30%. That's fine. My rents aren't really that different. And I got this 10-year fixed loan and I'll just wait then. Yeah. But if you own 10 shopping centers and you need some money, you start selling off your 2 good ones that are full, cool. That's what we were buying.
Yeah, we saw it again during COVID, right? I mean, we weren't sure transactionally what was going to happen with the multifamily market in COVID, but it ended up being really healthy. But from an operating level, the owners were like, all right, I'm still collecting revenue. If the value went down, it's fine because I don't need to sell it right now. And it was the same back then. I mean, the buildings from an operating standpoint were able to sustain the changes during the economic crisis. Yeah. But the retail centers and the office buildings and some of that had vacancy that did not allow it to sustain the crisis, right? It's one of the reasons why I love multifamily is I feel like you're insulated because people always need a place to live, and they're going to have to pay for it, or the government's going to have to pay for it, depending on how you're set up with the vouchers or whatever. Yeah. So it's interesting. But, okay, so you didn't see as much distress in the multifamily space, so you were acquiring more retail. Yep. But now you're a multifamily guy, so there's a lot in between now and then. So when did you become at least partially a multifamily guy, right? Yeah, well, I never realized that I'm just was doing only multifamily till basically like within the last year almost, actually. I'd say, okay. We, in a lot of those early deals, they went so well. I mean, we still own almost all of them, but we are calculating the returns. And if we sold them today, I mean, a lot of them would be between 5 and 7 times our money on them. So they went tremendously well. The strategy, we'd rather just keep it. Like I was telling you before, you want to keep the chips in play. You sell it. Okay, cool. You made a 7X, but you then
what do you do from there? You take it off the table. Like, we still like the deals we own. I have sold a handful of deals, but it's usually based on that individual asset. Like, if we like the deal or not going forward. So all the deals we've sold, I've viewed them as like our weaker deals. Until, now we would sell stuff if it's like, we feel like it's small, like it is like too small for us, but it doesn't make sense to own anymore, with then the hope of ideally like rolling that up into like one bigger property. But the ones that we sold, because we sold a shopping center in 2014, an office building in 2015, and then another shopping center in 2019. Those were all just, at the time, we viewed those were these things have like peaked value wise. There's more almost risk to holding them. Like, we lose a key tenant, well, this thing will be worth less. So let's move it.
Okay.
So yeah, I mean, in terms of where we went, I mean, so then just kind of pick up the story from 2008 to 2011. I lived in Rockford, and then we had bought sort of our sixth deal in Minnesota, and we weren't totally sure what's the next move. We had invested all the money that Jim wanted to invest at the time into those Minnesota deals, and I was ready to be sort of done working as an employee. So I quit my job at Rubloff, and I started doing Blackhawk full time. But I also had time to travel. So like in a year period, I went to, I think, 12 countries. And then after all that, I moved to Chicago, and we started looking at multifamily here. So that's in 2013. Okay. So then bought my first, didn't waste any time. By June 2013, I bought 3 deals, and there's off and going. There's still.
So how'd you find the deals? Because you have no connections.
Yeah.
You don't know anything about Chicago.
Yeah.
You're relatively new in multifamily, I guess, on a larger scale. You had done the duplexes, and so how did you create your? And now, I mean, I'll put a little context on this for anybody listening. Like, now you're regarded as a very active buyer, a very established buyer, a trustworthy buyer. So how did you get started, and how did you find the inventory, and think about like your interaction with either the principals that you were dealing with or the brokers you were dealing with then?
Yeah. Looking, let's say, back over all the deals I bought, and we actually just added it up and calculated it for our new website, but 80% of the deals I bought, they've been off market or with a repeat broker or repeat seller. Yeah. At that point, I didn't realize that was sort of like our bread and butter. So I would just was looking for deals to buy that were marketed. I didn't know any brokers or anybody here really. So there was this 16 unit for sale in the Wicker Park neighborhood. And at that point, it was not even, it was like a changing area, and you could be at a deal and they'd be like, man, you'd be here 10 years ago. It'd be,
it's so funny.
Be scary. Yeah. Now where it's like super established, and, like some of these deals that people think are like, they're smaller prices, but trophy type deals.
Well, now you realize the rarity of a 16 unit asset being available in the middle of Wicker Park too. I mean, it's just not another that trades. It's low density, and there's not much transaction velocity on that size deal.
Only one other.
And you like kind of stumbled. I don't want to say stumbled in it, but that was just one that you found without.
Yeah, I think a lot of people at the time, they had, like a lot of pause on the price per unit. It was a $350,000 per unit in like the end of 2012. So that's a big price.
Yeah.
The only reason I care about price per unit is because I think when you go sell it, some buyers will be more conservative with how they value it because of the price per unit. But otherwise, I'm not looking at price per unit.
Yeah.
I'm looking at, what's my, yield on cost, which is just a fancy way to say like, what's my finished NOI divided by my finished price once you're done with whatever your plan was.
Yeah. So price per unit is an example. I think cap rate is an example too, where somebody just looks at one metric in a vacuum and says like, I buy this cap rate, or I buy this price per unit. And you think about how much they're missing.
What if the rents are above market?
This is a 16-unit deal in Wicker Park, was a new construction failed condo conversion or failed condo development.
Yeah,
huge apartments, good rents that are below market, and you identified that. I mean, looking at that apples to apples with a building with all one bedrooms, vintage one bedrooms, it's like it's fundamentally flawed. I mean, cap rate's the same way. You think about how quickly the needle moves on if somebody's looking at a cap rate. You need to put it in your own context, your own business plan, and how are you going to run it, and what do you believe that you can do? Otherwise, it's as soon as somebody calls me and I'm like, "What are you looking for?" I'd like to buy a 6.5 cap in whatever market. It's like,
yeah.
Okay, all right.
Right. What's
like,
I need to know your expense ratio or something.
yeah, what's the
here.
expense ratio? Yeah, how do you run it yourself? If everything is apples to apples, that's fine. That's how we look at comps in a book. But it's rarely the case.
Yeah.
So it's interesting. So you found this deal that a lot of people were missing. It was 16 units in the middle of Wicker Park. I mean, I know the asset. And was it competitive? I mean,
no, I was the only person bidding on it. Yeah.
It's nuts to think about that.
Yeah, and I didn't realize how rare the deal was at all. And what's funny, you were saying those rarely come up. Nothing like that came up, a 16-unit kind of thing like that, until for 6 years later. And then when I did, I bought it. Yeah, because then right? I remember you were saying you got someone would want to buy that, but we already had it.
You kind of swooped in on that one pretty quick.
Yeah, that could have only been on the market for a couple of days. But really. So again, similar thing. I didn't really know the market that well. When you think about now we buy a building. I mean, we literally think we have it underwritten exactly how it'll go. If I bought that same deal today, I'd have 10 rent comps that I own that I can pull. These are after advertised rents, and I have, exact expense comps, exact everything. Been through a ton of property tax appeals. I got an insurance person to talk to, like where I'd have it underwritten so tightly now. But then I guess to finish the thought, I would focus. I was just similar, like just make sure this thing cash flows what you want. And our metric on that deal, we wanted to have cash on cash at 10, which I know would be crazy now, but at that point we were well over a 10. This was assuming we were running it, so I don't know if like leasing fees were in there, but there was a management fee and there was full other expenses. It cash flowed over the 10, and I was just like, don't overcomplicate it. Just that's the deal you need. And same as the first deal, if you overpaid or whatever, just let time sort of fix it. Yeah. And your investor's happy because he wants to make at least that. So then you're delivering that, and then we're just gonna hold it. I just kept it simple.
It's funny, man, because now it's like now on the operating level, down to probably 1% on your expense ratio how it's going to go. And you know down to probably 1% on your rents how it's going to go. And then you didn't. But there were other challenges in the market. I think like people listening might get caught up in thinking like, oh, it was easy. Anything that somebody bought at that time turned out to be successful.
Yeah, but
nobody knew that.
Yeah.
Like I was brokering deals at that point, and nobody knew how it was going to go.
Yeah.
So there were different challenges. I mean, getting the deal financed, finding the investors. I mean, you were buying a lot with Jim at that point. But like nobody had the confidence in 10 years of strong performance at that time.
Yeah.
So it's funny to think back. It's like, yeah, you just kind of like you lucked into buying this great deal, but it was tough there, and not many people were doing it. So and now difficulty's probably in finding the inventory, not in knowing how it's going to run.
Yeah,
right?
For sure. Yeah, no, it's interesting how you described it. Yeah, because at that point people were. Yeah, I'm the only one bidding on it because people are still worried that we're not out of the recession or this price per unit's too high. But again, I was trying to keep it simple and just focus on the cash flow. And then, this first deal we're talking about, it went incredibly well where we bought it for $5.7 million and like a year or two later, the price for over $8 million. So we still own it. So I didn't sell it, but that's pretty good.
Yeah.
So.
One day you'll have to shake that one out.
Yeah.
So you bought that one. What else were a couple of the first Chicago deals?
Bought an 8-unit in the North Center neighborhood.
Oakley one?
Yeah, 3600, 3610 North Oakley.
Yeah.
That deal, similar, was already rehabbed by a guy who does a ton of rehabs and really experienced operator.
So it was the same broker, well, not me, but it was the same broker as you bought the Wicker Park deal from.
Yep.
It's funny, you said 80% of your deals are off-market or repeat brokers, either principals or brokers. And my business, I looked at this recently, is it was over 2/3. It might be over 70% now of the deals that I've done have been with a repeat client on either the buyer or seller side.
Yeah.
And as when you think about that in the context of the business that we're in and how tight the network is, it really puts a lot of pressure on making sure that you do what you say that you're going to do. And I don't mean pressure in a bad way because you want to anyway. But it's funny, you look back and as a young guy starting, or young gal starting, you got to think about like how meaningful every interaction is, because you might do another 10 deals with that person, especially if you do a good job.
Yeah, right? You're right.
And so that was a big source of inventory, and I know remains a big source of inventory for you today, is just being trustworthy to deal with and performing, right?
Yeah, I get sent a ton of off-market deals, and sometimes I almost wonder why. Like it's I'm getting all these looks, but it's when I talk to people, I mean, yeah, we're easy to work with. We like just do what we say we do. We explain what we want. We're just clear, and so it's and that both those first two deals, those were marketed. Okay. So even though the same broker, I wasn't getting any off-market looks yet.
Yeah.
But yeah, and same thing. That was just another deal for cash flow. The third deal, 1801 North Clybourne in Lincoln Park, that one was a rehab deal. So we were going to renovate it. The prior owner, they added a retail tenant, created a insane amount of value in the property, and then was just more like a 1-year hold for them.
Good real estate.
Yeah,
busy
and then
corner.
Yeah, and then someone from your office, Brad Feldman, sent that to me.
Yeah.
So that we worked through Brad on, and was a great deal. Similar to that, we rehabbed that. I mean, I think we probably were all in for like $4.5 million, and it appraised for over $6 million. So it's similar deal, but a location we don't want to sell.
So all these are different neighborhoods for anybody that knows Chicago. I mean, Wicker Park, North Center, and Lincoln Park. They're all affluent neighborhoods. They're all established neighborhoods. They're places you go and hang out and you're comfortable and everything. But they're similar probably from a pricing metric standpoint.
Yeah.
I mean, is that what you liked about them? Did you just what were you looking for location wise? Because it wasn't like that you were buying a couple buildings next to each other where there was a huge amount of economies of scale and being in one particular submarket, right? But they were similar.
Yeah, and really I think what I was looking for is I was targeting the established neighborhoods and then trying to just find the one, messed up or mispriced deal or deal that had the rents way below market. This the deal we're talking about now in Lincoln Park that needed a full rehab. Then the first deal, the rents were way below market, and so like that was our opportunity on those. So we weren't looking so much in like, okay, what's the next neighborhood to buy into, and then it'll grow into us. My thought was like, we'll just find the deal that is under rented, underpriced, and you're already in that market. You create the value in a year. You don't need to wait for anything to improve.
Yeah,
you just create the value immediately.
I like that better myself. Like there are guys who have a sense, and we know some of the same ones who have kind of a pioneering way of looking at new neighborhoods and are able to improve a building probably past where that submarket's historically used to and attract the tenants and get the rents and kind of push the envelope in terms of the fringe neighborhoods.
Yeah.
But I feel like that's it's a business plan that you really have to have confidence that it's still going that direction.
Yeah.
It's hard. What you're looking at, I mean, these are neighborhoods that have been Wicker Park. There was enough trajectory to see that it was on the way up. But North Center and Lincoln Park have been affluent for a long time. You weren't making any. There was no location risk for those deals, right? I mean, it was just an operating level value at play.
Yeah,
I like that. So let's make a little segue. I wanted to ask you a question about, and we were negotiating a deal recently, and I want to ask you when you decide. You're kind of smirking like you already have a feeling. When do you decide to stretch versus stick to your number when you're down to, call it a couple percent? Yep. And a couple percent on the size deal that I'm referring to is a lot of money, right? It's hundreds of thousands of dollars. So, what is it that makes you push one more time or stick to your guns? Because it's like every deal, as a broker who's negotiating these things, there's always that last push that's the hardest. And I feel like you have a good way of staying disciplined, but you obviously buy a lot of real estate, so sometimes you have to make that last push, right?
Yeah, so I guess I would answer that with, really it depends on the type of property I'm buying, where it is, and then like who are your partners in it. Like that plays a huge factor. Where, let's say most of the deals today, we're trying to deliver like a certain net return to our investor. So if you're already at that number, then it's super easy for me to just stay there. Like I'm not going to move from there. That's just the number. Where if you're buying, and let's say it's your own money, and you have way more flexibility. I mean, you like the deal, you can go after it. You're buying it, and you have another reason to, you might want to push on it. Like I think this area could be better longer term. That's not in my spreadsheet, but I'm just going to push a little. It's tough if you have an investor where you want to deliver a certain net return to them. And I don't want to start out a deal thinking that like I need like a miracle to happen to like catch up now because I overpaid.
Yeah.
So if you think I'm disciplined on sticking on a number, like that's why, because we have how we think it'll go. A lot of times we make like a base case scenario and an upside case and a downside, but we're bidding off the base case. Like the potential for things to go way better. That's
gravy. That's not the reason for doing a deal.
Yeah, because we've had deals that have gone even better than the upside case. We've had some that are a lot of them go like how we underwrote it.
Yeah.
So then, so for us, it's easy to stick to it because we're trying to deliver a certain return. And then I'm just looking at the screen basically going, this is what we can pay. Here's how we underwrote it. And especially now, if we're talking about like a Chicago apartment deal, like we have so many comps that we own where we really think like we have this underwritten well from an accuracy standpoint.
It's funny though, because what you're buying is kind of sexy real estate. It's very in-demand real estate, newer construction or significantly improved multifamily product in popular urban Chicago locations is attractive real estate to own right now, right?
Yep.
But I feel like you never get out over your skis where you never talk yourself into paying more than you feel like you should. You should, but a lot of people that I deal with, I feel like they get kind of an intrinsic value that they apply towards it because they're like, man, I just like to own that piece.
Yeah. I could see that making a lot of sense if it's all your own money, because then too, you could be making a bet on, fine, this deal on the spreadsheet is not as good as the other one, but I want to own this one for 10 years and beyond. So then I got transaction costs, other things to worry about later that aren't really on this sheet. So I just want to pay up for the deal I want now.
So if you lose a deal, and a lot of my clients are what you described, like legacy owners, generational hold owners, and they look at everything very globally and want to accumulate over time. And there's huge efficiencies of scale in doing what they're doing. So in some of what you're buying, you compete with them. And if you lose one of those deals because you compete with somebody that just really wants to own the asset, that's fine. Move on to the next one. Huh? That's how you look at it?
Yeah, I don't think there's very few deals where I think like, oh, I wish I would have paid up and got it.
Yeah.
Yeah, that's really rare. No, I'm confident in those kind of like choices, I guess.
Yeah.
There's one where I remember it was early on when I was buying those first 3 deals that I didn't get. I was like too conservative on, and they had hit like a home run on it, but I wasn't sure on the area at the time.
Where was it?
2000 North Milwaukee. Yeah. And one of the people at the property was talking about how, man, if you were here 10 years ago, we'd all be scared right now and all this stuff. And I was, new to the area. So I got a little more conservative with it, but that was further, not as nice of an area as where I had been buying. So then probably rightfully, okay to be safe with like a location choice at that point. But that's one of the few deals where I'm like, man, I wish I would have, but only reason I'm saying that is because that area got so much better, and then it would have the growth would have came into you. But at the time, with the info I had, I mean, I think it's a fine choice. But no, I don't have any.
And I'm sure you bought another good deal. And you put the money that you had allocated to invest, yours and your investors, to work into something else that was productive. So
and then even if I lose there is a deal that I had that we had going, you and I, where you had sent it to me. We had it under LOI. We couldn't get the purchase contract signed. The seller decided they don't want to sell today, basically. So I didn't, I'm okay with how that went, because I don't feel like I know how everything's going to play out yet. We couldn't get that deal done, but maybe the next one I do, it's going to be even better. So I don't know how that will work. And then actually, I guess to answer your question on how do you move on price? So I think of Chicago as a more stable market. And then I also mentioned like the product types. I mean, depending on the product type in the market, that to me dictates a little bit about how you want to get on pricing. So this past week I was in Phoenix, and like year to date, like their rents are up 20% there.
I heard that.
And so that's a place where it's funny to think, but if you push on price, well, this is gonna be a price in 4 months. Like place is moving so fast. That's a place where you could go, all right, well, if I never move on price, I might not get a deal, and then a year from now, these are all worth more than where I was even had to stretch to.
So let me play devil's advocate, because I know you've thought about it. So in a market like Phoenix, a 20% rent growth is absolutely not sustainable, right?
Right, of course.
I mean, there's a huge influx in population and such. There's a lot of job creation, so there's a lot to like at a demographic level there. But at some point, the supply is going to catch up and the rents are going to flatten. So I imagine in those deals, they're competitive because it's very popular to buy in Phoenix right now. How do you confidently underwrite rent growth knowing that the clip that they're on is not sustainable?
Yeah. Well, we're obviously not going to underwrite, 20% or, even in the high single digit. But yeah, the Phoenix is interesting, and some of these other places like Tampa, what's going on. There's so much, they're having such a population boom, but also of higher income people than who's there currently. So in Phoenix, even though the rents are up 20%, the rent to income ratio is down. So meaning like the people that move there are making so much more money that the their rent to income it went down. So they can definitely afford these rents. And so really the issue would more just be if they overbuild. And we're looking at these deals from more of a 3-year hold, the 5-year hold going. We think it can run like this, and usually we're assuming, like, let's say you mark the rents to market. That's the thing there. There's been such a big run up in rents. Things are all over the board. So you have a lot of sort of the similar opportunities to what I had in Wicker Park, where the rents are way below market because they shot up as that neighborhood got really, really nice. That's happening in Phoenix now, where you have deals where you're not, people didn't push rents. Now they're 20% below market. And then if you maybe add on under 5% annual increase from there, like this deals look strong, but it's tough to hold long-term in a place like that. If you think there's going to be a lot of supply, or you have to put a lot more money down.
Yeah.
So we've started to change up what we're doing, where everything in Chicago or Minnesota, we were looking at really long-term holds. And so for any new market we go into, if it's a growth one, we're looking shorter term, and then we're just going to decide at that point. Like we go in with the plan's going to be a 3-year hold, but then let's just see where we're at in year 3. If things are still how they are now, well, great, let's hold it. Why do you want to sell then? But you
like stress test it for 3.
Yeah.
Okay.
Yeah. 3 and 5
years.
years.
That's the base case in your
yeah.
Okay.
Yeah. We're here. If we talk about my base case is 10 years.
Yeah. Right.
So, but there you would not hit the return in 10 years unless you assume some real aggressive rent growth.
And are you looking at the same return metrics in Phoenix as you look at in Chicago, or because it represents a different bucket for you and your firm, do you adapt, or do your deal level like returns change because it's differentiating? Or
so really, on those on the Phoenix deals, if they're shorter, the way we've been looking at it, we're just adjusting the multiple on equity that we want to earn from, based on the period being shorter, but what we've been seeing for the right deal, you're getting a higher IRR on those Phoenix deals just because there's so much value add, but it's also shorter.
Yeah.
So we're not really comparing apples to apples. I mean, really, like how we've been thinking about it is, your Phoenix and your Tampa, that's like a growth stock maybe. And then your Chicago, I mean, that's, the cap rates are a lot higher here. Things are more steady from a rent standpoint. I mean, that's maybe more like an income stock. So neither is, better necessarily, or not, one's not good, one's not bad, but they're just different. So then, if things go according to plan, it's a shorter hold, but your return's higher, but it's a different deal. It's mostly on growth. So the cash flow's lower, and it's most returns just come in on sale.
Yeah.
So it's just a different profile. So depending on who's the investor or who would be in the deal, it's just different.
Yeah.
If you want cash flow, you better off buying here, in Chicago. Yeah. So just different animal there.
You guys are on an awesome run. You're just at this point buying with Jim and Brian, right?
Yeah,
Blackhawk.
Blackhawk. Yeah. And we're just essentially recycling money that Jim had put into the business. So our strategy, we talked about the first 3 deals we did there, but then the next, I think the number's 13. We did 13 deals in a row where we bought them, raised the rents, and then cash out refinanced all the money or more than all the money we put in. And then did another one. Yeah. So we just recycled the same money. It's $3 million, just rinse and repeat, where we ended up getting $30 million property total. Just repeat. It buys, with $3 million, you buy 10 to 15, you do your refi, you do it again. You pull out your money, you do it again. We've kept them all so far. I mean,
that's awesome.
We're looking at selling some of the smaller ones, but that, Yeah, so we're running and gunning, and we're thinking, just kind of keep doing this. But in 2019, actually, Brian passed away. Just like unexpectedly in his sleep. So kind of everything changed really at that point. So yeah,
and I remember talking around that time.
Yeah, and so I mean, really, my plan was like I had obviously done my own deals before, and I was using the name Breneman Investments at that point. Yeah, I was just thinking I'd only do Blackhawk, but then it was really like Brian and I were the younger partners, and then the dad he was really the investor. So the dad Jimmy stepped up a lot since then, where he's basically my like day-to-day partner and does a ton on the Minnesota stuff. He's got a construction background, and we've had to do a fair amount of leasing with losing tenants during COVID. So he's been really invaluable. But yeah, it's a sort of real, I mean, just crazy where you think you spend basically, your whole life working together with the guy, and he, passed away. So really, and totally like unexpectedly. So really kind of just shook everything up for all of us. And yeah, so Jim had to really step up. I mean, he sold his business and then had to stay on there for a while, but he was coming to the end of that period. And then he, I know he was looking forward to retirement, and, so he's been my day-to-day, operating partner essentially, on all these deals we own together, so that really changed things a lot where, I had been just thinking I'm going to do deals with Brian basically. Yeah. We've been working together a long time. So, we were selling a deal for Blackhawk, so we finished that out. We ended up buying two of our, I think our largest two deals that we bought as part of Blackhawk. We bought in 2019 in this 1031 exchange we did. Okay. But then sort of after that, kind of our plan with Blackhawk, we'll buy more, but it's not going to be like what it was. So then I wanted, to kind of get back to where I was. We're doing my own deals. I had been using the name Breneman Investments, when I had first started. So I thought like, okay, I'll kind of repurpose that. And then that's when I created the Rise Invest brand. Yeah. Way easier to remember. I was thinking about using the Rise Invest or the Breneman Investments name, and actually started it. But I had an interesting moment where I had the Rise Invest name, gotten that from my wife at the time. And then I couldn't remember someone else's like their name, another real estate sponsor, but I remember their company name so easily because it was such a clear name. Huh. So I'm like, there you go. Like I should go with Rise Invest. That's super easy to spell, easy to remember. Where this Breneman Investments, how many N's or what's the thing, like that yeah, same thing could happen to me. This is easy. I was able to get the domain riseinvest.com, and I think I have riseinvestmint.com and just some other like domains around it. So I was able to kind of secure it, and so went for it. Started pushing that harder. I started in 2019 also with like a new partner, Sam Meyer, where we started Dwell. Good guy. Yeah, he's great. And then so we initially starting that, we were just going to focus on buying apartments in Chicago, and we'll be vertically integrated, buy the asset and then manage and lease it, handle the maintenance. So yeah, we started out with that pretty hot in 2019. I think we bought.
So what was like you made me talk about my brand when I was in. So what how did you think about the brand of Rise Invest? When you at the inception, not necessarily today, but you'll get to today. At the inception, what did you want it to be? And has that changed at all in the first couple of years, or are you kind of reiterating or proving what you thought that it would be?
Yeah, I think it is today. It's kind of what I thought it would be a couple years ago. It was just where what I wanted to do was create something where, like we just had catered to more investors. So it was like a new product, new challenge, if you will, where instead of building the company necessarily just around one investor, one type of thing, like just where to be open to more people, and then kind of focus the business more so. Where with Blackhawk, it was a lot of fun. Like I think I had mentioned where we did a bunch of different product types. Yeah. But the only thing that we really went through and refined for Rise more so after really picking the name and going with it was just making sure we were firm on the strategy. So over the course of last year, we went back and we ran a bunch of different calculations with NACREIF data. And one thing we did, it's up on our website on the homepage, and then also on the Y multifamily page, we calculated the Sharpe ratios, volatility, and absolute returns for all the major product types. And multifamily over the last the time period was, I think that we have on the website is 1990 to 2020.
Okay.
Multifamily has the lowest risk and the highest returns. So, and the trends, obviously past performance, not, necessarily all the way indicative of the future, but all those trends that were helping multifamily, I mean, they're still there with the renter population growing, aging population looking to start renting again.
So you bought a 72 unit deal in the middle of West Loop, 72 apartments over street level retail, $33 million.
Yep.
Which is like 3 times as big as the next closest deal that you've bought in your career, right?
Right.
So this is a big bet to make in a crazy time when a lot of people were not bullish on buying or were at least not bullish on making big, I wouldn't say bets, but investments, right? Because I remember people at that point, in retrospect, we know that the market performed really well during COVID, and the collections were strong. On the operating level, the buildings were really strong, and values came back basically as soon as transaction velocity came back. But at this time,
definitely
it wasn't there yet, right? Because at this time, I remember you must have toured this deal in the middle of summer if you closed in October. And I remember everybody was like, yeah, Joe, market held up pretty, collections held up well in May, but what about June?
Right.
And then in June, they were like, yeah, June was fine, but what about July? I mean, everybody was still like tracking it on a monthly basis, like holding their breath on the first of the month. So what did you see in that deal that gave you the confidence to buy it? And maybe where were you at from, what was your psyche at that point? Like, how did you decide to go for it in such an uncertain time?
Yeah. 2020, I've never checked my accounting software so much with rent collections or other, different deferrals and deals we had to work out with, people. But what's funny, I mean, I like when the market is down or there's some sort of weakness, I'm more interested in buying then. Like I know a lot of people say like you should, buy low, sell high, but it's hard to it's hard to condition yourself to do that probably, but I just, I think of myself as a professional investor and I kind of don't get emotional about it. I see it, and it's sort of, hey, now's when things are down. This is when the opportunities will be here. And the investor partner we have on that deal, he's not looking for like quick flips or something. He wants stuff he can own for, maybe 10 plus years. So if you think about, basically a brand new trophy type building, you're going to own it for 10 plus years. What happens the next year or two? It doesn't really matter that much over the course of the 10 years.
Yeah.
So,
and you were buying probably a depressed rent roll because you had a weak leasing season right before you bought it, right?
Yeah, the rents were down a little, but really it was more just, I think the valuation was, was a discounted or a good buy because we were in the middle of COVID, so there was so much uncertainty. And
that was talking about having an apples to apples comp. I mean, it's sometimes hard to see how big of a discount that you bought, but there was a pretty similar asset that traded.
Yeah, same developer. I mean, they had 2 other deals that they built and then sold. One of them was on, so we paid $420,000 a unit for this deal if you include some value for the retail. And there was another one that they had sold, I think, earlier that year. It's like a maybe a touch nicer, but that sold for, I think, $550,000 a unit. So like a big difference. And then also then there was one, I think a year prior sold that is in a, like that 550 one, that's in a comparable location. And, the finishes might be a touch nicer, but not, maybe not even stuff renters notice.
Yeah.
So, and then our per foot was way below these other ones. I just don't have those memorized anymore, but it was similar discount on that per foot. So it wasn't like those units were so much bigger or anything. And then there was one on Jackson that sold, I think a year before, and that was $460 a unit. And then that's for the West Loop. That's not as desirable,
fringier location.
Yeah, I mean it's the location for that one's fine, but it's not. It's further from everything.
Yeah. So I mean, you say that you're between, the first comp that you referenced. I think that one was on Monroe. That one was like almost a 20% discount, 18 or so percent discount. Jackson was 10.
Yeah.
So I mean, it was a pretty identifiable depressed value that you were able to acquire this at, right?
Yeah, and I mean, in terms of how we got to the deal, I mean, that might have accounted for it a little bit. Where I don't know if those other ones were like fully marketed.
Yeah.
This one ended up not being fully marketed. What happened was someone was going to bring it to market. They had sent it to some people like ahead of time, and so the price that they wanted, it was sort of like what would have been, I think, like full price normally.
Market pricing.
So then I threw out like a number, like, hey, this is like kind of where we'd be at. And I thought like that's like a range we would consider, like come check it out. So we toured it, let's say like on a Thursday afternoon in August, and we had it under LOI to buy it by Friday lunchtime. Signed LOI, like done.
Wow.
So we moved quick on it. We had to assume their loan.
So you underwrote it on. Hang on, you underwrote it on the front end.
Yeah, we always underwrite.
And toured it, and it validated what you thought. So you were able to turn around an offer really quickly.
Yeah, on every deal we underwrite before touring.
Yeah.
So then you know what to be thinking about when you tour.
Yeah.
And then you just update your underwriting when you tour.
Yeah.
So yeah, we did that, and then we got under LOI.
Wow.
So yeah, and again, just kind of the way we think about the deal, like knowing you're getting a good buy. At the time, I didn't think it was, like so discounted necessarily. I just thought it was a good buy. But then I had explained it to one of my buddies who works at East Hill Secured, and he was like, "What's a cap rate on that?" And he suggested one that was like 100 basis points lower than what we were bought it for. And I was like, wow, if that's how it'll go. And that was kind of like a sign of what was to come, at least. Like then values, really catapulted higher everywhere. Cap rates have dropped the last, 12 months. Rents have gone back up. I mean, it's been, so whether or not we bought it discounted or what,
Did you close it with agency financing?
We assumed the loan they had, which was a Freddie, or was a Fannie, green loan.
Okay.
So, yeah, so we assumed their loan, and then that was we've sort of created like a little niche almost, or I've assumed, maybe 4 loans out of like the last 6 deals. Like it's kind of if you've got a tricky deal and you need an agency loan assumed, we're your shop. So I've done.
Well, it trims a lot of the buyer pool because some people they kind of write that off. They want to put fresh debt on it. Or people haven't been through the assumption process in some cases.
Yeah. And honestly, it's harder than the acquisition loan.
Yeah.
Because
you can just underwrite for it. I mean, it's just you change numbers in the model, right?
Yeah.
It's not that hard to see. And if you're able to acquire the real estate at a lower value and you desire to hold it for 10 plus years, I think it's a good model. Yeah,
and we're solving to like a net investor return. So if you have to put a lot more down, that'll make your returns lower. So we still got to make sure that checks all the return boxes. But this did at the price we were at, and we're a really great buyer when there's an assumption. I mean, I've done I think 30 agency loans now. So it's, when I present that with the offer and say, I know you got this Fannie loan you need assumed, great. We've done like 30 Fannie or Freddie ones.
Which is the opposite of what most people are saying. They say you have a Fannie loan to assume. Oh man.
Yeah, right. Yeah, so we realized that, so we're able to do it, but we want to get a bit of a deal for doing it.
Yeah.
So we made it happen, and they were able to sell it during COVID, and
you got a lot of positive press for it too.
Yeah.
I mean, it was a good deal. I think it was a really, really good deal for your brand and for you as a buyer. I think it seemed, from my standpoint, to be kind of almost like a springboarding event, where it really seemed to kind of like elevate what people thought of you, right?
Yeah, because we had been looking at, we had offered on a $45 million deal like earlier that year, and we were looking at bigger stuff, but that was, to that point, the largest deal I'd closed was $13.5 million, and that was earlier that year.
Yeah.
So then, that was, it's a lot easier to go to like a $40 million property now or whatever and say bought something for 33, close it during COVID.
Yeah.
So that, that's definitely right.
And you bought a few deals since. You remain active. So in addition to looking at Phoenix, which you talked about, you're still very actively acquiring in Chicago.
Yeah. Yep. So just trying to expand, get some, good exposure to those growth markets everybody's talking about.
Yeah.
So
it was fun to be able to flip the script on you a little bit.
Yeah.
It is a lot. I mean, I've known you for like 10 years, maybe almost 10 years, and we talk a lot, but I didn't know you were a magician.
Yeah. I try to deliver the 2-sentence story.
I didn't. It was cool to hear it. Thanks for sharing it.
Yeah. Thanks for being on. And then if anyone's interested in investing in any multifamily deals with Rise Invest, you can go to riseinvest.com. We have our whole portfolio on there now. And then if you want to sign up to see future deals, those are open to accredited investors. You could just click the Invest Now button, fill out your information, and we'll get in touch. Joe, how would people get in touch with you?
I'm easy to find, man. My last name is spelled Smazal. There are not that many Smazals out there, so Google Joe Smazal. I'm pretty active on LinkedIn. That's my best social media for business stuff, so track me down there. Cell phone numbers 312-848-6682. I'm easy to get in touch with, so find me online. It'd be great to connect with you.
Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com, where we have numerous free resources and information that can help both active and passive real estate investors. Our 100-plus page passive investing guidebook, our trends report, and our blog are all available on our website. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.